Sorry, I was on mute. Hello and welcome to our third RegTech Live Driving Innovation Through Compliance event. My name is Khawla Al-Ali. I'm a manager in our Innovation and Technology Risk team at the Dfsa, and I'll be your MC for today's event. The event, the third of its kind, reinforces the Dfsa's goal of fostering innovation in the DIFC in line with the Dubai's National Innovation Strategy of His Highness Sheikh Mohammed bin Rashid Al Maktoum, Vice President and Prime Minister of the UAE and ruler of Dubai. This event is also part of the DIFC Innovation Month, a month dedicated to innovation and bringing together the regional fintech and larger innovation community to discuss trends, opportunities, and challenges. This event is also the official launch of the DIFC Innovation Month, which is the largest fintech and innovation ecosystem in the region. Today's event will be a mixture of demonstrations. You'll also hear from the Dfsa about their views on innovation and financial services. So let me quickly take you through today's agenda. We're going to start off with opening remarks from Justin Baldacchino, the Managing Director of the Dfsa's supervision team. Then we'll have our first batch of the RegTech providers demonstrating their solutions. We'll then have a crypto asset update presented by Elizabeth Wallace, a senior manager at the Strategy, Policy and Risk team at the Dfsa. Then we're going to hear from the second batch of the RegTech providers demonstrating their solution. Then we'll have an innovation policy update presented by the Managing Director and Head of Strategy, Policy and Risk, Peter Smith. And then we'll wrap it up. There will be opportunities for you to ask questions during the event. So if you have any question, you can type it where you see the question mark. If you're on a laptop, it will be on the right side of your screen. If you're on a mobile device, it will be at the bottom of your screen. There are approximately 300 people registered for the session today, so we won't be able to get everyone's question, but we'll do our best and get as many as we can. One last thing, if you're having any technical problem, please check your Wi-Fi and check your firewall. Sometimes there are glitches, but we have tested the functionality of the GoToWebinar many times, and it's often not the interface playing up. So I won't hold the event up any further and will now hand over to Justin Baldacchino, the Managing Director of the Supervision Team at the Dfsa. Justin, over to you.
Thanks, Carla. Appreciate it. Good afternoon and welcome to the third edition of RegTech Live, Driving Compliance Through Innovation. As a principle-based regulator with a risk-based approach, our primary goal is to reduce risk, and this is why we began hosting the RegTech Live event. The objective of the series is to drive awareness of the RegTech solutions that are available to assist firms in mitigating risk. Today, in addition to seeing demonstrations from a number of third-party providers, you'll hear about some of the areas that are within the focus of the Dfsa's 2021 and 2022 supervision risk lens, and our priorities in addressing these risks. In the few brief moments I have with you, and understanding that this is a session focused on technology-enabled services, I'll share our view on supervision in the context of innovation financial technologies. Before I begin, I'll make one very important point. No matter the technologies deployed or the products or services offered, our core regulatory objectives continue to be to maintain financial stability, the integrity of the market, and the protection of clients at all times. Technology may change how we view our risk, but no amount of technology innovation will change our underlying objectives. It is this view of risk that drives our supervisory priorities. I will touch on a few key aspects of technology risk and supervisory priorities in this area. You will hear me say the word risk many times over. Many firms underestimate the potential risk of their own firms and don't appropriately assess the risk or identify potential issues, which is core to the work that we do here at the Dfsa. New technologies bring many promises. Some promises are that to bring more speed and transparency to payment and transaction flows. Some promises are to simplify operational efficiencies. Technology innovation in compliance processes promises to reduce false positives in transaction monitoring and manage compliance with cross-border regulations, and others promise to reduce and manage more effectively. The promise to reduce and more efficiently manage risks is what regulators want to see. but I would be remiss if I didn't outline that for every risk within a new technology of what is mitigated, a new risk is created. And that is where we will focus our efforts going forward. Where an institution implements a new technology or an innovative product or service, we will look to ensure the risks associated with the new technology, product or service are effectively identifying, assessing, mitigating, and continually monitoring those potential issues. And where an organization outsources its technology needs to a third-party provider, we will look to see that the authorized firm takes appropriate steps to mitigate the risks of the third-party vendor. The third-party risk is steadily moving higher on our risk register, and we are steadily increasing our focus on how well firms manage, monitor third-party risk. Unfortunately, we all too often find that firms outsource a function to a vendor under the belief that the vendor has now taken the responsibility for that function and all the processes and controls that go along with it. That's not exactly how it works. You can outsource the function, but you always maintain the responsibility for it going forward. Your responsibility for the actions of the third-party vendor is at utmost our focus going forward as well. Therefore, we'll look to see that firms conduct proper due diligence on their vendors. We will look to see that firms understand how their service providers control their own technology and cyber security risks. And we will look to see that firms have processes in place to conduct ongoing monitoring, periodical reviews of their vendors' cybersecurity controls. We don't have to look too far into history to understand the risks that third-party providers present to your organization. Last week, a cloud computing service provider caused a 49-minute shutdown of the websites of huge organizations such as PayPal, the Financial Times, the Guardian, the New York Times, the BBC, as well as UK government websites, and two major US retailers such as Amazon and Target, to name a few. 8 weeks ago, we had a further event of SolarWinds, which was attacked through a malicious code that was injected into the systems of over 18,000 businesses that use its services. These included government agencies, Microsoft, cybersecurity vendors, and a numerous amount of Fortune 500 companies. What made this hack unique was the malicious code was embedded in a software update that was distributed to SolarWinds clients. Installing updates is one of the most basic ways in which we better protect our systems. So what we do when these updates become the delivery mechanism for the attack itself? That's a very good question, and it will be something that we'll be looking to see how firms address this risk. A key point about this is that SolarWinds attack was not an attack that was widely contemplated, but now that we know that such attack can happen, we expect firms to learn from it, and we do expect it to be something that is more widely contemplated going forward. We are seeing increased adoption of a number of enabling technologies such as APIs, cloud computing, biometrics, big data analytics, and also artificial intelligence and distributed ledger technologies. Each of these technologies carries unique risks and each requires bespoke risk controls. In response to this rapid adoption and in collaboration with the UAE Central Bank, the Securities and Commodities Authority, and ADGM FSRA, we recently issued guidelines in relation to the financial institutions adopting enabling technologies. The guidelines themselves consist of high-level principles and best practices for firms that are considering adopting or having adopted enabling technologies. The guidelines were produced to encourage the safe and appropriate adoption of these technologies so that risks arising from the adoption of these technologies are appropriately addressed and managed. We expect firms to apply the guidelines in a proportionate manner that reflects the size and complexity of their business, as well as the nature, scope, and complexity and materiality of the activities undertaken. That said, the guidelines do not create new obligations for firms. However, firms should expect the Dfsa to refer to these guidelines when discussing relevant issues when conducting risk assessments on the ground. In due course, the Dfsa may include some or all of these guidelines into its rulebook, in which case the obligations created would need to be adhered to in the same way firms would adhere to any of the other Dfsa administered laws or regulations. I encourage all authorised firms to read and familiarise themselves with the guidelines And although we have already published the guidelines, authorised firms have the opportunity until the end of June to review the guidelines and submit any comments to the Central Bank of the UAE. I'll now mention a couple of specific risks. The first risk is cyber risk. You can't use technology without exposing your business to cyber risk. For that reason, over the past 2 years, we have put a great deal of time and effort into driving cyber risk awareness and setting expectations for how firms should be managing the risk. In September 2019, we activated the cyber incident notification mechanism on the Dfsa e-portal, and in January 2020, we launched the Dfsa Cyber Threat Intelligence Platform, TIP. In June 2020, we published the findings report from the cyber risk thematic, and in December 2020, we published cyber risk management guidelines, which held several key cyber risk focused roundtables as well over a 2-day period. We held our third cyber risk threat intelligence workshop not too long ago, and I'll also touch on for a moment on the cyber risk guidelines. The guidelines explain our expectations regarding the governance, hygiene, resilience, and measures firms should have in place to manage cyber risk, and we will use these guidelines to guide our cyber risk reviews in future. This publication should be considered as a first step. We will issue more enhanced guidelines in the future, and we'll also ensure that more enhanced guidelines based on the scale of activity and the overall cyber maturity of the centre grows in future. For the past 2 years, we've focused on generating awareness and setting expectations. Now we are shifting our focus to monitoring and testing firm cyber risks and controls. This year, we began conducting cyber-focused risk assessments of a group of authorised firms. Each year, we will select a different group of firms for the purposes of assessing how well those firms have responded to the findings of the thematic review and have begun to implement the cyber risk management guidelines. Consistent with the cyber risk management guidelines, we'll be looking at the firm's cyber risk governance arrangements and the involvement of senior management, which is at the heart of ensuring that we have the right controls in place. What we've also seen, more importantly, is that we will review how well each firm is prepared in identifying and responding to and recovering from a cyber risk incident. You have heard us say this on many occasions, and we will say it again, and that is that a cyber risk incident is not a matter of if, it is a matter of when. As technologies advance, so do the criminals committed to attacking them. Therefore, your organisation's defence will likely always be catching up. The most important thing you can do is make sure you have the response mechanisms in place to ensure operational resilience in the event your organisation falls victim to a cyber attack. The second area is suitability. Many of the new digital asset products, such as cryptocurrencies, utility tokens, and stablecoins, are targeted primarily at the retail market and raise new concerns about the suitability of such products. Suitability is an issue that is often misunderstood and is not appropriately applied to the circumstances of each client. We will be looking to see that firms that offer these products, where required, offer proper suitability checks before offering the product to individual clients. We will look to ensure that you have appropriately assessed the risks of the products in the context of the client's experience, knowledge, and risk appetite. This year, we concluded a thematic review focused on suitability and expected to publish the findings report in Q4 of this year. I encourage you all to read the report and understand our expectations in this regard. Lastly, but certainly not least, is Aml and Cft. This remains at the top of our risk list and will likely stay there for a very long time to come. New technologies, in particular the cryptocurrency, offer a new mechanism for clients to transact in more transparent and less costly ways. But at the same time, they can offer a mechanism for criminals to transact in a less so transparent way, and they also support the secret movement of illicit funds. Some blockchain technologies offer the promise of transparency in transaction flows. Others offer the promise of secrecy. You have to understand one thing in dealing with certain cryptocurrencies that we have seen. It's more around the tools to conduct effective monitoring. We will watch to see the firms that in fact adopt appropriate tools to manage the risk. You will see demonstrations of a couple of relevant tools later in this session. I will finish this update with a focus on our Innovation Testing License Program, ITL, the core of our Innovation Supervision Program. The ITL is now in its 5th year. It was launched in May 2017. To date, we have received over 105 formal applications and invited over 51 innovative companies to join the program. These have included companies offering AI-supported SME funding, digital debt issuance, conventional and Islamic, AI-supported wealth management, robo-advisory, insurtech, token crowdfunding, and payroll solution applications, as well as escrow solutions, payment and cross-border money transfers, and e-wallets. The program has proven to be invaluable in supporting the safe offering of innovative technology-enabled products and services, and we intend to continue to offer the program in the foreseeable future. We are now preparing to launch our 8th cohort in July. For this cohort, we will entertain applications to security token offerings. That said, I encourage you to read the consultation paper 138 before submitting your application to make sure your proposed business model is consistent with what is in the current consultation paper. You can find CP 138 on the Dfsa website in the section for consultation papers. Again, I would like to thank everyone for joining us in today's event. I'll now hand it back to Carla. Thank you, Carla.
Thank you, Justin, for your insights. We have invited 4 RegTech providers in this batch to demonstrate their solutions today, and all of them offer a unique insight into different technologies that can be utilized in the market. Please be aware that the participation of any demonstrator in this event does not in any way constitute a recommendation or an endorsement by the Dfsa. The Dfsa is not responsible on any basis whatsoever for any information presented by the demonstrators and has not reviewed or verified that information. Each of the demonstrators will have a total of 5 minutes to demonstrate their solutions. You are welcome to submit questions to them, and if there is time, they can answer them at the end of their session. If there is no time, they can answer them offline. We're going to start with Darren. Darren is a VP of Europe, Middle East and Africa and Asia Pac from Big ID. Darren, I'll turn it over to you. Welcome, Darren, and welcome everyone.
Lovely. Thank you very much. Really appreciate the time. So I'm representing Big ID, and we are an American company which is currently establishing an entity within Dfsa. Essentially, we provide data discovery technology that assists organizations with understanding their data estate, and it can certainly support the activities as highlighted by Justin in the previous presentation related to cyber risk and the Aml and Cft side of things. But essentially, the technology itself is revolving around the discovery of data, employing the latest techniques, including different mathematical disciplines to find data quickly and accurately. And this supports a wide variety of initiatives within organizations. Of course, it supports the compliance side, it supports the privacy side, it supports the data governance program, but the cybersecurity landscape, and of course your cloud migration requirements as well. And essentially, all of these different disciplines and requirements that organizations have revolve around one unifying variable, which is the data. And understanding your data estate and being able to understand the context of that data is very, very important. And there is an opportunity to employ your budget for compliance to also drive an increase in your security posture and make the right data available to the right data citizens at the right time. And so this technology from Big ID is fundamentally a data discovery tool which will assist with these requirements. And essentially, the business outcomes that we're looking to address, of course, are to reduce the risk. A cyber risk, of course, is high profile. You can only protect and apply compensating controls to the data that you're aware of. And profiling the data based upon the risk you carry is one of the deliverables. We can help with data lifecycle management. Of course, this is an important consideration. Organizations want the to make sure that the data is the most appropriate data that they're using, and that they're not poisoning any of their data models based upon old data. And so lifecycle management is an important deliverable. We can drive business innovation, of course, through exposing the right data to the right data citizens so that you can have the appropriate business intelligence and you can have the appropriate mathematical models for giving you the opportunity to deliver new services and to your customers. You can increase your customer trust based upon how you align to your regulatory compliance and the privacy drivers and so on, and demonstrate that you are taking the appropriate care as the custodian of customer data. And of course, you can achieve compliance, and this is an important deliverable. And so the way that Big ID essentially works is that we drive discovery. And we're able to assist you with discovering, driving discovery and classification of your data, standardizing data definitions, and the profile of the data. And then moving beyond that in terms of classification, understanding the sensitivity of your data, driving risk scoring, standardizing on business glossary and business terms and so on, and applying that to your data estate. And then ultimately enabling your data stewards and your data quality managers to really take full advantage of the data that you hold as the most valuable asset in your organization. And then to identify where data is non-compliant with your policies internally so that you can drive remediation related to mitigating those situations where data may not be aligning with your internal policies, whether that's data sovereignty policies, whether that's data retention policies, or whether it's access policies and so on. And then ultimately allowing you to enforce activity on the data to resolve those situations, leveraging the native tools or other security tools that you have in your environment, things like data loss prevention tools or data obfuscation or minimization tools that you might have within your data estate. And so the way that Big ID does this is essentially we are able to connect to a wide variety of data sources, the widest in the industry. And this is structured and unstructured, semi-structured, mainframe, Kafka, Kinesis, your SaaS applications, your cloud infrastructure. And we connect with a read-only capability, a read-only connection. And then we employ different mathematics to then analyze the data in those different data silos. And we ultimately present the results through a data registry, which is called the data catalog. And so we're using a deep learning neural network, we're using graph theory, we're using fuzzy mathematics, all to provide a deep insight into the data in your estate. And then on top of the discovery foundation, we have a suite of apps. And these apps service the different business use cases. And we broadly group them into privacy apps, into data protection apps for security use cases, and into data governance apps for data perspective. And so ultimately giving you the opportunity to drive the outcomes that you're looking for in terms of customer 360 visibility, your lifecycle management, your security, your compliance, and so on. So if you would like more information on Big ID, it would be our pleasure to give you a product demonstration rather than this initial positioning. And you can take great confidence. We service a large variety of the Fortune 100 financial services customers, lots of very large, well-known brands that you'll be familiar with, and we can talk to you about that in more detail. So I'll leave you with my contact details here. And it would be my pleasure to field any further questions that you might have. I think I'm tight on time, but we'll take the questions and I'll respond to you offline. Thank you very much for the opportunity, and thank you, the Dfsa.
Thank you, Darren. I think we have one question for you, so if you can stay on the webcam. Okay, so how can organizations optimize their compliance investments to also drive innovation?
Yes, so in order to drive your compliance related to data in your environment, whether that's privacy compliance, whether that's the security drivers, or whether it's things like AML or the funding of terrorism, then understanding the transactions, understanding the context of the data, understanding where your data is located, which is what Big ID can deliver. The byproduct of doing that is that you then have the absolute visibility of the data, the context of that data, that can then provide the foundation for innovation and creation of new products and services for your customer base. So the positive outcome of funding the requirement to service the compliance driver can in fact produce the byproduct of wonderful transparency across the data estate and provide you this data intelligence that then gives you the platform for innovation.
Okay, great. Thank you, Darren.
Pleasure.
I'm now going to invite the next demonstrator, Shilpika from Elucidate. Shilpika runs the strategic partnership team at Elucidate. Shilpika, over to you.
Amazing. Thank you, Kuala. Can you see my screen okay or not? Not the one.
Mm-hmm.
This is the one we want to see. Sorry, my desktop is really messy. So thank you for the opportunity. I'm Shilpika. I run partnerships at Elucidate. Elucidate is a regulation tech company. We have a big ambition. We are building the Moody's of financial crime risk. So what that essentially means is that we provide quantified, data-driven, very objective scores for every financial institution on the planet for the financial crime risk that they're exposed to, whether it's on the enterprise level or it's from the network that they do business with. So this could be your respondents network, this could be the NBFIs you deal with, this could be affiliates, this could be the fintechs you deal with. Basically, we want to bring all the data and all the noise around financial crime risk under one umbrella. We want to measure it, we want to score it, we want to then give this information out to banks, to NBFIs, to regulators to decide how best to set risk appetites to manage financial crime risk in real time and not be one step behind, but always be one step ahead. I was listening to the presentation earlier. So this is really what we want to do. In particular, I'm very delighted to be here and speaking at the Dfsa webinar, because over the last 6 months, we've engaged heavily with the region. We've just announced a partnership with the EMF and the BUNA, so our monetary fund. We're spending a lot of time in the Arab region, and it's really exciting to really share the platform with you today. So I think in first instance, there are many people with different understanding of financial crime risk. I want to raise the point here, the financial crime risk is a humongous problem. There's about $4 trillion laundered every year, and these are not faceless dollars. They are real people being trafficked, they're real people being enslaved, and that's the money that's passing through the financial system today. Financial institutions try really hard or not often hard enough, to understand, where this money is coming from, but they're still getting fined for not detecting and not doing enough. And $2.5 billion every year is a pretty hefty amount for the financial ecosystem. And the question then is, with all the tech we have at hand today, with more data than ever, why is it that banks and financial institutions can't detect financial crime? It's because the systems in use today are heavily manual. They're heavily they really rely on people to make really hard judgments with very little objectivity thrown in. So if you just look at the quick numbers here, for a bank like Citibank, they're probably spending up to 3% of the annual revenue, so about $2 billion on detecting less than 1% of illicit payments that they may process. That's a ridiculous return on investments. So that status quo is pretty depressing and frankly a horrible return on investment. So where we take the view that, first of all, we need to be able to holistically imagine and detect and assess 100% of illicit payments. Because if you don't know what's in your system, how can you get better? So that's the lens we apply. We want to expand the landscape of detection from 1% to 100%. And how we do that is by using our proprietary platform. Is called the Elucidate FinCrime Index, and it's essentially a model. It's automated, and it relies on millions, essentially millions of data points in the public, proprietary, and institutional data space to accumulate holistic financial crime pictures for financial institutions, and deliver very reliable, very defensible financial crime metrics in real time. And how we do it is taking as I already highlighted, a very strategic approach, because financial crime risk is not restricted just to compliance. It's not restricted just to first line of defense, but it's a phenomena that impacts entire organizations and entire business models. So financial crime risk really has to be a strategic risk endeavor, and not just sort of relegated to just compliance, even though many institutions sits with compliance. We also take, as I pointed out, millions of data points across multiple sources to build holistic pictures, nuanced pictures of the risk that financial institutions carry, both as a result of those they do business with and a result of their own business models. And we aim to show in very objective, actionable insights format what you can do with this information and how can you improve your risk trajectory on a continuous basis. Because that's always, there's always going to be criminals doing something that you're not doing. So you want to be ahead, not behind. These are some of the ways in which we can work with financial institutions. And just know that this is not, if you have objective information on financial crime risk, there's a zillion things depending on your business model that we can do for you, do with you. Some of those solutions include, monitoring your network and your portfolio for financial crime risks, automating enhanced due diligence, very expensive, very painful process. We can look to monitor look to optimize your current risk assessment processes if they're really manual, move them to automated. So compliance people, first line of defense people, MDs really just focus on the stuff that matters, the risks that matter, instead of looking at all the zillion data points that are frankly overwhelming and not going to help you fight back and mitigate financial crime risk. This is a quick snapshot of what our reporting looks like. Again, very happy for you to get in touch later, and then we can talk through what those sort of things mean, but there's just a little look into what the platform may look like. We also have now about 17,000 institutions on the platform. So we have a risk rating for each of these risk institutions. In fact, a little teaser ahead of next week, we're going to make these 17,000 risk scores public as of next week. So if someone here today is on the call and are curious what their Elucidate FinCrime risk rating might be, get in touch. I will give you the sort of this VIP code to get in this week ahead of everybody else next week. So we're really excited to put that database out. And we know that by creating objective metrics around financial crime risk, there is more fairness in the system, there's more inclusion, and ultimately better return on investment for everybody involved. And don't believe me, believe the people we work with. So we're a regulated platform. We're regulated under both ESMA and the BaFin. We are delighted to have partnered with Abu Dhabi Global Markets, the Central Bank of the UAE. We're working with Standard Chartered. We're working with our monetary fund. We have great clients across the globe, and really, really excited to hear from more of you after this session today. Here are my details. I would love to talk more about what exactly is it that's bothering you, or the problems that you're trying to solve, or the innovation you'd like to bring into your organization with respect to understanding your financial crime risk and fighting it in the most effective metric-based objective form possible. Yeah, so that's me. Get in touch. My details are right there. And if you want to know more about our brand new database of financial crime scores, then ping me for the secret code. Back to you, Kuala.
Thank you, Shalpaka. I think we have 1 minute to take one question only. So why is it important to quantify financial crime?
Absolutely, great question. So traditionally, every bank has, almost every financial institution that's regulated has had to report on financial crime, be it to their board and be it to their regulator. And in the way the financial ecosystem works, with the people they do business with. So in the correspondent banking model, if you are a bank in the Middle East who clears dollars with JP Morgan in the US, you are obliged to send a report of what are the measures you're taking for assessing financial crime risk. But that process is so incredibly manual today that from the time you start assessing an institution's risk and the time you end, it can take anywhere from 6 months to 2 years to know what is the financial crime risk picture of this institution. And that's based on maybe, 20 data points, 100 data points if you're really ambitious. But if you look at just the crazy amount of information flooding our minds and our systems today, especially with COVID-19, banks having gone digital for the first time ever, that information is just impossible to contextualize in a qualitative manner based on manual understanding. So we need to use that data that already exists within institutions and analyze it so we can spew out objective metrics, quantified metrics that will allow senior people, be in compliance or client coverage or at the board level, to only care about the kind of risks that are out of sight or out of their risk appetite instead of going after the million data points. That's not effective, and that's not actually good ROI. So I think for running more effective businesses, we need to quantify financial crime risk and also to let people focus on this kind of risk they care about instead of the million data points we're all bombarded with today.
Great. Thank you. Thank you, Shalpaka.
Thank you. My pleasure.
I'm now going to invite Terence, a solutions manager at Tiger. Terence, over to you.
Thanks, Carla. Hi, everyone. My name is Terence. So I'm representing Tiger to share with you the solution we have today. So rather than actually presenting slides and all that, thought it's best for you to take a look at what is happening in the system itself, right? So over at Tiger, we leverage on AI to do a couple of things, which is extract information, search information, and to communicate via virtual assistants. But what I'm showing you today here is actually based on the extract system itself. Now, as you can see over here, there's a couple of processes that the system goes by. I won't go into all those, but it's actually all these are happening at the back end. Now, what is interesting with the system is that, of course, I've uploaded a sample Emirates ID here. But what happens here is that the system actually captures information from all over the document itself. Now, what we use differently is that we don't go by zone that I'm sure many of you are familiar with. So we leverage on natural language processing, or NLP for short, to understand the context and the intent, right? So of course, with a standard ID like this, it's easy for us to capture information. If I were to go into a passport, so again, I managed to find some online samples to demonstrate this. But essentially what you're seeing here is that we're able to capture information from different areas and different zones. We also identify how accurate the system thinks that we can capture based on respective content. So like in this case, we are capturing from the MRZ zone at the bottom here, because through our experience, of course, on our passport, that's the most accurate area that we can capture information from. So we actually leverage on different capabilities mixed with our NLP technology to then capture the best and most accurate information for you. Now, just moving on, what you're seeing is actually a very structured content here, right? But when we look at unstructured content, which I'm sure many of you have heard about, things like the RPA, right? So RPA can capture IDs and all that, but there's only so much they can do. What happens for us is actually we work to get very closely with RPA vendors to actually enable and empower more for the organizations. So what happens in this case is that over here, you're looking at a power of attorney document, so which is obviously a very unstructured document with a lot of content. right? So when I look at the information that the system is capturing here, notice that over here is actually seeing something else. It's not based on a very structured content and say that, hey, actually this information is over here, right? So the system understands that, hey, first name Michael, second surname is George. We can capture other information as well, the designation and all that. But what is more interesting is actually at the bottom, where, let me just scroll it down. Over here is where we see the powers. Now notice over here is where the system identifies this clause here actually refers to opening of account. So what happens here is that we actually teach the system based on this clause. It actually means open account to my business, right? So of course, in your context, we can apply it based on your respective business needs. So of course, some of you might look at this and say, hey, but you know, there's open account here. So let's look at the one at the bottom here. We have trained the system based on, of course, the variations to actually identify that, hey, this clause actually refers to sign-specific agreement. So if you were to look through this, you won't be able to see exactly the word sign-specific agreements, but the system understands the intent behind. So that's essentially the gist of it. I won't go into the details of everything, but hopefully in future, when we get the chance to talk to you, we can have more conversations on that. So with that, feel free to visit us on our website, tiger.com/UAE. Just wanted to bring your attention to this slide over here. Now, essentially, like I mentioned earlier, we have different products. So what I've just shown you is the abstract portion of things, but we have different products here. So just feel free to reach out to us if there's any use case that you need, and talk to us. We'll be happy to hear from you. Thank you so much. Back to you, Carla.
Thank you, Terence. We have some questions for you. So what is the rate of error here and how can we mitigate this?
I'm sorry, come again?
What is the rate of error here and how can we mitigate this?
Oh, what is the rate of error? Right, so firstly, I have to highlight that in all extraction, because that is dependent on OCR capabilities. Right, so there is also factors like noise. For example, within a document, there are the security components, right, especially in passports and IDs. So more often than not, the misconception about AI is that it's all 100% automated. So in our approach, usually it's a mixture where we actually require customers, the users, to do validation. So in this case, of course, there will be scenarios where, if let's say, for example, if I were to touch on the ID, if let's say I'm confident that the document extracts at 92%, we can tell the system that, hey, based on 90% confidence and above, just pass it through. I don't need to check. But more often than not, if let's say it goes below, then that's where a human validation will need to come in. So that's how we mitigate that, because like I mentioned, OCR technology is, there's no way it can achieve 100% at this juncture. Yeah.
Great. Thank you, Terence. I'm now going to invite Siddhartha. Siddhartha is the founder and chairman of Emulia. Siddhartha, over to you.
Thanks. Yeah. Can everybody see my screen?
Yes, we can.
Paula? Okay, great.
Yes.
Thanks. So just 30 seconds on what we are at the core. So what you would see over the next 5 minutes, some of it would seem very disjointed because I will show you a KYC demo with a video. I will show you corporate disclosures, audit processes, etc., which currently are served by very different kinds of products. But because we use first principles of artificial intelligence, we are able to do all of them using one common core engine. And all our solutions are aligned to different steps in the 3 lines of defense process. So we have different interventions for the first line, second line, third line, and some for the regulatory oversight. So the first demo, in absence of client consent, we have 2 quick screenshots to show you. which is controls testing as part of the audit process. And two examples that I've chosen is, one is payment processing. So the auditor, what does he do? Goes there and checks the payment instruction, checks the SWIFT message, and checks if they are aligned. This is a process which is completely done by our AI engine. So you then don't need to do sample-based testing. You can actually do 100% of the payments process tests. Extending the same technology for the same global bank, another control that test that we automated. This is reporting to the DTCC, where we read the trade confirmations, the Murex and Sabre screens for the same, and the term sheet. So this is one process where we are not automating the process, but automating the controls testing. And now I'll switch into few demos for which I will. So this is a KYC process which allows through an OTP to verify an individual, take the consent of that individual, get the national ID of that individual loaded based on the consent, which we read if that country allows us to check with the national database of that country. We will be able to check and get the person's detail. Additional check, tax ID, just flash it on the screen. We will read of it, driving licenses, passports, etc. Verify the signature. Do a liveliness check if that person is really live or faking it. And based on that, create a complete profile with multiple checks, including fraud detection checks and geotagging done for the individual to complete that KYC check within seconds. And where this gets more interesting is that now you are in a new country, you want to add another ID. Data privacy does not allow you to share IDs. You can just self-train the engine for new IDs. This is a demo on securities regulation we did with an American bank. These are 200-page credit agreements. Some of it, Terence from Tiger had shown how you can read contracts. So part of it is the ability to read contracts. This is for securitization due diligences, where you have to read thousands of loan contracts, which is extracting fields, etc. But this is where it becomes interesting, that as part of your due diligence, suddenly you realize that engine was extracting 6-7 fields, but you need to extract an additional field. And some of these could be paragraphs. Now, I also want to know who is the administrative agent across all the loan contracts that I have. I key in, I will get a suggestion. So I go mark it and save it so that the engine self-trains. I will have to do it for 5-10 samples. And then when I upload the next documents after training that, then you will see the real power of artificial intelligence kicking in. So I'm uploading another contract. And now if I go and check this contract, the administrative agent field is a pre-filled field. So you can easily self-train the engine. This is something we have done with a North American regulator recently, which is corporate disclosures. For this sample, we are picking a couple of them where they wanted to have corporate disclosures on diversity. So the engine got trained, and across all the companies that the regulator is monitoring, they can just quickly through the engine check all the diversity related disclosures, a number of people on the board, number of women on the board, percentage of women on the board, and if there is any commentary regarding diversity by the company, that is done as well. So that's kind of few different samples that I chose. So if you think of the video in the KYC solution and the image coming to a document like this or going to an audit process, to a lay person, they appear completely distinct things. But all this in our case gets done using one common technology. So I'll just switch to my presentation. Happy to take any questions if they're there.
Yes, thank you, Siddhartha. So we have one question for you. If local regulators don't allow to validate the document, then how you can mitigate the risk?
Yeah, so there are 5-6 fraud detection checks that we do, which is in terms of morphing, photoshopping, all this. We have our AI models which have been tested, and means they are global benchmark data sets, etc., on which you check your ability to figure out fake images, fake IDs. So we run all that. So the final profile that you get of the person, that profile will include fraud detection review as well. So because we don't want to say yes or no directly on a fraud, the profile will say that we suspect that this person's image is superimposed, or we suspect that this is an image of an image. So all these kind of checks will be part of the final profile recommendation that we make to you. And plus we are doing a cross ID validation. So in this case, for example, you saw we took the national ID and the tax ID. So if you are doing that, then we will cross-check the national ID with the tax ID to see consistency of information. So various checks are built into the whole process.
All right. Thank you, Siddhartha. And thanks to all the demonstrators. We're now done with the first batch of the demonstration. So if you have any question, you can type them in the question box, and they can answer them offline. I am now going to introduce my colleague, Elizabeth Wallace, from the Strategy, Policy and Risk team. She's going to provide a Dfsa crypto asset update. Liz, over to you.
Okay, thanks for that, Haula. Good afternoon, everyone, and thank you very much for letting me all speak to you today. So what I'm going to do is give you a really brief update on where the Dfsa is at with the regulation of crypto assets, or at least that's what we're calling them. They can sometimes be called digital assets, virtual assets, cryptocurrencies. There's many names for it. So while the language can be different, they all have similar characteristics. They're a type of asset that depends primarily on cryptography and distributed ledger technology. So what have we done? The Dfsa has spent a good part of the last year looking into the nature, characteristics, and markets associated with crypto assets. We've talked to many other regulators who are also, quote unquote, dipping their feet into this water and seeing what they're doing, what risks they're seeing, and how they're going to address them. We're also talked to lots of market participants, exchanges, custodians, wallet providers, crypto asset infrastructure providers, to further our understanding and get feedback on how things really work in practice. I would say this has been a really valuable process for us. We're able to get a far better understanding of what these firms are looking for in a regulatory framework, and also how we can constructively work with them as we look to license their activities in the future. And why have we done this? Well, really, regulators have a difficult job. We need to take a really objective approach. We obviously want to support and encourage innovation, hence our support of DIFC's Innovation Month, but we don't want to encourage or support innovation that compromises our regulatory objectives. Now, I know Justin mentioned this earlier, but just to reiterate, that's ensuring consumer protection and also to maintain market integrity and financial stability. We always have these at the forefront of our mind. And this crypto asset market's new to us, and given our talks with other regulators, it's very new to them, and we see quite a few risks. These include money laundering, counter-terrorist financing, challenges around market liquidity and volatility, which everyone's seen more than once, for example, with Bitcoin. There can be technical and operational difficulties. There's fraud and cyber risks. There's client suitability and understanding. And then there's the whole global nature of this ecosystem. I could go on, but I won't. Regulators need to stop when we talk about risks. So what the proposals we are developing, we want to include a certain amount of flexibility. We want to allow for innovation, but our regulatory objectives are not flexible. They don't adapt to new products and services. So we've had to manage all of these areas, and this takes some juggling. However, we have been quite busy, and some of you have may seen that we've published the first phase of our work in this area. That is the framework for regulating security tokens. This was set out in CP 138, and we issued this in March this year. This is now closed and we're considering the comments made. The second phase is where we're going to look at all other types of crypto assets that don't meet the criteria for being security tokens. So I'll go through both phases to give you a bit more insight into what's been happening. So we looked at security tokens first. Why did we do that? It's because this is the area we've seen significant interest in. Many of the firms we've talked to have indicated that this is what they would like to do. Also, this is an area which has a closer affinity to conventional investments that we already regulate. So it provided a clear opportunity for us to expand our existing regulatory regime to address the regulations of these types of tokens. Lastly, it offered us sort of an opportunity to test the waters, so to speak, and see if the measures that we have proposed provided the right balance between encouraging innovation and addressing the potential risks we saw in this market. I'm not going to go into all the details of CP138. You can find that on our website. But what we did was we set out very detailed guidance to assist market participants to determine whether the tokens they propose to issue, offer on market, in or from the Dfsa, are in fact security tokens. We then looked at proposing additional requirements to regulate security tokens. Clearly, going back to our objectives, our proposals focused on promoting investor protection, market integrity and stability, whilst also addressing AML, CFT, and the other risks I've mentioned, but hopefully in a proportionate manner so as not to inhibit innovation. I'll talk about some of the key aspects of the proposed regulation. We have created the ability to admit to trading of security tokens on Dfsa regulated exchanges and MTFs. We've proposed systems and controls related to requirements applicable to trading venue operators, including a new requirement for an independent technology audit. We've allowed direct access to trading venues, including by retail clients, which is a significant deviation from our current intermediated model of trading. We've put in place additional requirements for digital wallet providers who are going to hold security tokens. We've added additional disclosure for prospectuses and other types of offer documents which are used for offering and marketing security tokens. And lastly, we've put in place some additional requirements for other financial services providers who are, for example, dealing, arranging, advising, and conducting asset management activities that involve security tokens. So as I said, we issued the CP in March, this consultation closed in April, and we're going through the responses now, which actually have been very favourable, and we're hoping to come out with our final framework soon. I'll touch on phase 2. This is what we call the rest of the crypto asset ecosystem. And the types of crypto assets we're looking at in this phase of work include exchange tokens, also known as cryptocurrencies. You'll be familiar with Bitcoin, Litecoin, Ether, those types of crypto assets. Utility tokens, which typically offer access to a good or service. Stable coins, depending on the characteristics, they can also be called asset reference tokens or e-money tokens, for example, in Europe. And these are crypto assets aimed at maintaining a stable value by reference to a single currency or basket of assets, for example. There are going to be some crypto assets we are not going to allow. For example, crypto assets which are created to allow transactions to take place anonymously. Now I'm going to talk about the ways that we see these types of crypto asset used. Similar to security tokens, we see these used for investment via the trading of crypto assets. We see them to support crypto capital raising, We also see them as a means of exchange, enabling the buying and selling of goods and services, or to facilitate payment services such as money remittances. So what are we considering? Well, much like our work on security tokens, we're looking at how to appropriately define these types of crypto assets without being too restrictive, so that we can accommodate the evolving nature of the underlying technology, but also balancing the need to provide legal certainty. This was a clear request we received during our engagement with all the market participants. Then we're going to think about how we're going to deal with the issuance of these crypto assets and what type of disclosure needs to be provided. Then we're going to look at how to treat those activities relating to crypto assets like trading platforms, exchanges, custodians, and we're looking at whether the rules in place we have are sufficient. And lastly, we're going to look at how these crypto assets are marketed and to whom. We're also giving thought as to how we're going to deal with firms that are already licensed by the Dfsa and want to engage with these types of crypto assets. For this phase, we hope to come out with proposals in Q3 this year. Now, if you have any questions on this, we are more than happy to address them, but we'll be opening up the question and answer stage at the end of this event. So thank you very much.
Thank you, Liz, for your insights. I just want to restate the disclaimer once again. It applies to all the demonstrators participating in this event. So we have invited 3 RegTech providers for the second batch to demonstrate their solutions. All of them offer unique insights into different technologies that could be utilized in the market. The first demonstration is going to be from Settlement, presented by both the VP of Sales, Sunath, and Victor, a blockchain architect. Sunath and Victor, over to you.
Thank you, Kaula. Hello, everyone. Hope you all can hear me loud and clear. So how we structured is in 2 minutes, I explain who we are, and then next 3 minutes, Victor show you a real demo of the solution. So we will be exactly within 5 minutes, hopefully. Okay. So once again, hello from Settlement. Settlement is a 5-year-old blockchain innovator based in Belgium, and we are one of the very few blockchain providers selected by World Economic Forum as a global innovator for 2020 and 2021. And I'm Sunath Kulazi, Vice President for Settlement Middle East and Africa. Right. So hearing blockchain, most of the time, some set of people think blockchain is Bitcoin, and whereas some customers look at blockchain like a Everest sort of complexity when it comes to implementation, which is true. It's understandable, actually. That's exactly why Gartner states around 14%, only 14% of enterprise blockchain projects move into production from a POC perspective. And if you look at the timeline, we're looking at 9 to 15 months just to complete a POC, right? So we are waiting. Companies are actually, unfortunately, waiting for more than a year to fail. So that's a scenario, right? So Victor, if you can. So the question is why 86% fail to move into production. So what we identified, there are 3 top reasons why they fail. 86% implementation fail in blockchain. One is the scarcity when it comes to skill set of the resources to get the right people on board to do the implementation. Second is the integration challenges around integrating and talking to all the entire system in the ecosystem. And the third is obviously to scale the consortium of the chain to multiple entities. So these are the top 3 challenges what we see, and this is exactly why enterprise gets stuck in experiments and high costs, right? This is where Settlement comes into picture. To make it very easy, we are the WordPress for the websites, Stripe for the payments, and Magento for e-commerce, for example. This is exactly what Settlement does for blockchain, make it very as easy as possible with implementation of blockchain technology. So if you look at a typical blockchain journey, it starts from setting up the infrastructure to building the application, integrating into the external systems, and scaling the consortium to adding to multiple entities into the ecosystem, monitoring follow-up. So Settlement offers end-to-end solution from a very visual manner with low-code approach. So you're talking about a 12 to 18 months project going live in 2 months, for example. That's the kind of time saving and value when ROI the customers have benefited out of Settlement blockchain as platform as a service, right? So if you look at Carrefour Belgium, they went live in actually 2 days. They went live over a weekend on a use case for supply chain track and trace. Yeah. So currently Settlement has around 40+ use cases in production across the globe. So we have offices in Singapore, Belgium, India, and Dubai. We are looking at 40+ customers and talking to different governments across the globe, and this is agnostic industry. So we are talking to multiple industries across the globe right now. So with that, I'm passing it over to Victor, who will be showing you real demo of the solution in 3 minutes time. Thank you very much.
Thank you, Sunath. So now I'll present basically the BPaaS platform, so Settlement Launchpad, on which you're able to create your consortium, so your association of company, which will be connected to your blockchain and your application, and then also deployment, so how to create a node which will deploy your application on your blockchain. So in this case, I'm basically creating my consortium from my association of company. I created for the sake of the demo just a random name, so test idea. If I go to the next step of the product, I need to choose a network protocol. So we have the main one and the most known one. So we have Ethereum, Hyperledger, or Coda, which is a private blockchain. I'll take Ethereum. Then I need to select my Ethereum client. We also have the famous one, which is Hyperledger, Chrome, and Ethereum. Let's take Hyperledger. And then if I click on accept the terms and condition, I created my consortium with only the specific company that I choose and also the definition of my blockchain. So once the consortium is done, I can create my deployments, my node. So basically the system which will connect to the blockchain in order to create your application and to use it. I also created put a random name. Once this is done, I can choose the infrastructure of my node of my blockchain. I can either choose the infrastructure which is a shared, dedicated on an on-premise. Then I can also choose the provider to host. So we have AWS, Google Cloud, or Azure. Different provider also provide different region where you can run your deployment. So in this case, let's take AWS and, for instance, Mumbai. Then next, I have the already built services provided by Settlement. So we have the middleware, which is a control tower of your application and your blockchain, where you can see metrics of your blockchain, your application, the users, but also how to integrate with it. We have a service called IPFS, which allows different users to upload data on the blockchain. We have also the IDE, which allows your developers to connect to smart contracts and make any modification and go directly from production. We have also integration studios, which is a software which enable your companies and your developer to easily integrate the deployment with your local infrastructure. And then Anchoring, which is the last service, it seals the data that you uploaded on the blockchain to make sure that your data is never tampered. So once it is done, you have an overview of your deployment. And if you click on accept, you have a running deployment on the blockchain that you choose within 15 minutes. Thank you.
So hope you're on time, Kaula.
Yes, you are. Thank you both.
Very good, very good.
So we've got one question to you. So how do you see the regulations and bad PR Bitcoin around blockchain impacting adoption in the region?
Good question, but I think Justin covered almost everything related to that question from a regulatory standpoint and what are we looking at. But yes, we cannot deny the fact that we have regulatory challenges. End of the day, it's an evolving technology. It's where internet was in probably 1980s, right? So governments are getting used to it, working on it actually. In the region, UAE is leading the race for sure. Even in November 2020, UAE passed a regulation for asset tokenization. So we see a very good positive impact coming out of it. That Saudi and others in the region following that very soon. So that's from a regulatory standpoint. So end of the day, governments know and should know that regulation is to enable transformation of businesses, not to do otherwise, to block transformation or growth of the economy itself, right? So yeah, so we are quite positive and hopeful to that.
Great.
Thank you very much.
Thank you both.
Thank you.
So I'm now going to introduce Yoran. He's the VP Regulatory Affairs at Theta Ray. Welcome, Yoran, and over to you.
First of all, thank you very much, Khawla. I guess you hear me and see me now, right?
Yes, correct.
Thank you. Do you see my screen as well?
We see your screen, but not your presentation.
Okay. So now you'll see my presentation as well. So, anyway, I will start. My name is Yaron Khazan, VP Regulatory Affairs in Theta Ray, with the company for years now. Do you see my presentation now?
Yes, we see it.
Perfect. I've been fighting financial crime all my career, over 20 years now. I started my career at the Israeli police. I worked 7 years at PwC forensics and AML practices. I was the head of compliance at HSBC. And with Theta Ray, it's the first time I feel that I'm one step ahead of the bad guys. In 5 minutes, I will show you now why I believe in that statement, and hopefully show you that in the same way that they solved the complex problems for correspondent banking and cross-border payments, I believe it's suitable as well for cryptocurrencies and blockchain. Theta Ray is an intuitive AI solution provider focused on financial crime detection for financial institutions and regulators that is based on artificial intelligence, unsupervised machine learning, we actually fit like a glove with the expectation for risk-based approach, and I will say why. Banks are expected to learn the customer's profile, to understand the risks based on the behavior and see if it's unusual compared to the profile. This is exactly what Theta Ray does. Theta Ray learns normality in the data, learns the behavior of any profile of any entity in the data, and based on that, detect anomalies. So, and if we match it with the relevant risk indicators, we provide effective and efficient solution to banks. I will demo it through a case that was well known between 2009 and 2014 as the Russian Laundromat, and was identified by financial institutions in the international community in 2017. White-collar criminals entered the funds into Russia, Latvia, and some other territories that had weaker controls, or they were able to pass the specific bank's controls and pass the money and send the money away through the clearing system all the way from the United States to Europe. The bank that wanted us to help him detect this scheme identified our 428 specific events, transactions, after 8 months of research by several analysts. We ran the system, and within a week, we found 8,400 anomalies. And the system also told us, like you see on the screen, the different characteristics of the unusual behavior. Neither the bank nor us knew in advance how exactly the bad guys worked. And this is why we say that in every project, we detect the unknown schemes. And we learned exactly what they did. We learned exactly the layering phases of money laundering and the integration phases of money laundering. We learned the behavior of opening low-risk companies as shell companies, registering them in company house in the UK without anyone within the name of the owners that is supposed to be known as a bad guy, and then starting moving funds on a monthly basis to make it appear as a customer-supplier relationship. When I say that we found probably all of the companies that were involved in that bank, at the end of the day, the 8,400 anomalies were related to 51 companies, and we found all the path of the payments and the cross-border activity of those companies, including originating accounts, originating banks, intermediary banks, and of course, destination of funds, whether it was in the UK or whether the funds were also sent later to other territories. I think that when you see the picture now in territories, I think in front of you, what it tells me is on the number of accounts as a pseudo customer is actually a number. Therefore, I believe that this solution can also be provided to solve cryptocurrency asset detection. Any questions?
Thank you, Yoran. Let me see if we have any question for you. Yes, we do. So why current controls and safeguards against money laundering and terrorist financing are not effective, especially in the cross-border payments area?
Thank you very much. A very good question. Today, most of the banks and the financial institutions and the fintech companies use a rule-based approach. Each payment goes between the originator to the beneficiary, sometimes with 4 institutions involved in between, sometimes 7, the minimum is 3. You cannot apply rules to detect unusual behavior by each one of the participants. Moreover, rules are best of pre-knowledge. All the bad guys know the rules that we write in the rule-based solutions. It's well known, so it's very easy to bypass them. The last reason why rules don't work at all is because when you define rules and thresholds, you limit your view of the data only to those specific events that fit the rules and thresholds. So what you actually do, you ignore most of the data, and you are blinded to see the unusual event and the suspicious events. Theta Array looks at the entire data, measures the behavior by all the participants, and find the unusual activities regardless of thresholds or predefined scenarios. And this is why we pinpoint exactly to those unusual events. And naturally, I believe that normal behavior is not a criminal behavior, and therefore we detect things that are most likely to be suspicious and potentially criminal.
Great. Thank you so much, Yaron.
Thank you.
So over to the final demonstration for the day. Over to Eve. She's a certified senior manager at Arachnes, which is an AML right source company. Eve, over to you.
Thank you so much. Thank you for having me here today. Can I just confirm you can hear me okay and you can see my screen?
Yes, we can.
Perfect, great. So I'm going to start by talking a little bit about data, because that is very much the foundation of the products that we've built. So I'm a member of Arachnes, which is an AML right source company, and we have worked over the last 10 years on building technology products to help automate and streamline the processes around KYC, AML, and enhanced due diligence within financial institutions. So we've built our foundation largely on data. As you can see from the screen at the moment, we have curated a really significant collection of data over the years, bringing in both publicly available open source data through a number of integrations with key open sources and through a really rich network of partnerships with third-party premium data providers. So what this means is that we're confident we can provide you with access to all of the external information that the world may know about your customer. And we can channel that into the various compliance processes that you have. We have global coverage with our data, so it covers 200 jurisdictions and is searchable in 98 different languages. So that means you can really get a comprehensive global view of any of the potential risks that might exist in relation to the entities that you need to do business with. So we take that collection of information and we use a variety of methods to channel it into your system so that we can support processes like KYC and onboarding, AML investigations, even transaction monitoring alert remediation, all using the data that exists within the world and leveraging enhanced technology and APIs to be able to enrich the internal processes that you have with external data. So that data is consumable in a number of formats via APIs in a purely programmatic way. We also have user interfaces, and you can also consume that in a hybrid method, so taking our user interfaces and integrating with your internal systems with API endpoints. So I'm going to start by diving into our KYC solution. So as the name would suggest, this solution is really designed to automate and enrich the process of onboarding your key entities. So as the diagram on the screen right now shows, our KYC enrichment solution will take fairly basic, even quite low quality input data from your CLM systems or from a client onboarding form, extract it with API technology, and then we can search against key sources like corporate registries, credit bureaus, any other key information sources that you have and that you trust. And we can extract key specified data attributes from them to populate an entity profile in full, enriching all of the information that you would need to have in order to effectively onboard a customer. And that means that you can reduce the number of RFIs and customer touch points that you have and reduce the kind of amount of traffic going through your front office. So you can really streamline and reduce the friction of that onboarding process. So just to give you a quick snapshot of what that looks like, we have this quite nice UI that presents you with an automatically completed entity profile. So we will automatically verify and enrich the information that's provided from either your CLM system or an onboarding form. And in addition to that, we will drill down into the corporate hierarchies of that entity. We can present you with the director information, the UBO, and the shareholder information. And we can even expose potential risks in a really scalable way by automating the process of screening against PEP lists, sanctions lists, and adverse media sets. so that we can identify any potential risks on your entity base and related parties as well. And all of that gets presented here. So what we end up with is a really nice streamlined process where you don't actually have to touch anything with any of your human investigators unless there's a genuine risk that needs to be identified or there's a conflict of information that requires human resolution. Otherwise, the entity is completely straight through processed, so with minimal human touch points, but with all of the information that you need to be populated and a really solid, clear audit trail of the fact that risk screening has been conducted and no risks have been identified. And once we have this nice profile populated and sitting within our system, we can then begin to proactively monitor against it for changes to KYC information or for emerging risks. So that means you can be proactively aware of any potential changes to the risk that sits within your customer portfolio. And that just allows you to be that much more responsive and proactive in the way that you manage risk across your entities, of course. So the overall process that we end up with looks something like this, where we're integrating with your internal systems via our API technology. We synchronize the entity data that you have, and then we use our technology to straight through process each of those entities, enriching them with important KYC data and screening for risk. If no risks are identified, they can get pushed into the automated monitoring set, where again, you'll only receive a notification if a new risk emerges. And if risks are identified, they can be appropriately triaged and, if needed, investigated and resolved before being pushed back into our CLM system and automated monitoring system to, again, proactively wait for any changes to information or the risk profile. So it's a really quick snapshot view of the KYC solution. But hopefully gives you a bit of insight into what we can do. We do leverage quite advanced AI technology to be able to resolve things like to conduct entity resolution and to remove false positives from our data. So you can be assured of a really nice clean data set that you're screening your entities across here, so we can automatically resolve those profiles with minimum human interaction. So I'll move on now to another product that we have in our suite called the Navigator solution. The Navigator solution has a range of use cases, but broadly speaking is designed to automate and accelerate investigative processes. So that covers a range of use cases like enhanced due diligence investigations on high-risk entities, remediating alerts identified through a transaction monitoring system, or even adverse media screening, where we find our solution delivers significant return, significant optimization and efficiency improvements over a standard desktop search using a browser like Google and manually screenshotting information. So we achieve huge realizations in efficiency, as you can see from some of the stats here, with our pretty simple system of curating the key sources that you need to search across to identify and expose risk, and then screening any entities that you have across that risk, and presenting the results in one really nice, simple user interface. So you consolidate all of that information into one view. You can capture and curate any relevant evidence with just one click and receive a full audit trail of any decisioning that takes place around this. And all of that results in one consolidated report containing all of your key risk information, which can be easily extracted and integrated with your internal systems. So I think I'm pretty much at time, but if anyone would like to learn more about the Arachnis solutions or the wider services AML RegSource can offer, you're very welcome to contact me. We'd love to hear from you, and we'd be very pleased to offer a full in-depth demo of any of the solutions we've discussed today.
Great, thank you, Eve. There is one question to you. How can Arachnis solutions help banks become more streamlined and automated in the approach to AML KYC?
Yeah, absolutely. So we can really facilitate that in a number of ways. I think probably the best way that we can support the streamlining of process is by leveraging an enhanced amount of AI. So we're investing very heavily in data science at the moment, which means that we can process results to remove false positives. We can conduct entity resolution within those results to make sure that the entity you're interested in is actually the entity that the article refers to, and we can make sure that any information that you are presented with is actually true and accurate. So that means that you reduce a lot of time spent sifting through noise, and it means that your investigators can focus in on really analysing the information that's presented to them. So we try to remove the more laborious manual parts of the process so that your skilled investigators can work on actually investigating and analysing, rather than screenshotting, collecting information, sifting through false positives, and so on.
Thank you, Eve. And thanks to all other demonstrators. I'm now going to introduce Peter Smith. Peter is the Managing Director at the Strategy, Policy and Risk team at the Dfsa, and he's going to provide a Dfsa innovation policy update. Peter, over to you.
Thanks for the introduction, Kaula. It's good to be here as part of our third RegTech Live event and as part of Dfsa's Innovation Month. Today I'm going to speak briefly about our innovation agenda. I don't think I have to convince many of you we're in a place where we're seeing the rapid adoption by financial services institutions of technology-based solutions. But why do financial institutions want to use more technology? A huge driver for the use of technology is data. The ability for financial institutions to process and hold data safely, and the ability to use that data to find out more about their customers or potential customers. The effective and creative use of data helps firms to increase their competitive edge, to defend, create or enhance their position in the market, and to offer their customers a broader range of products and services that meet their current and potentially future needs. Prevention is better than cure. Firms are seeking to put in place technology-based compliance solutions that, for example, automate administration, provide regulatory reporting, carry out Aml and Cft checks and monitor transactions. Technology can carry out these functions quickly, accurately and effectively, but it also helps to cut down on the cost of compliance. We've heard about some of those solutions today. What about regulators? The need to use technology and explore data is not limited to financial institutions. Regulators also need to innovate. We need to keep pace with the changes to business models, the increase of consumer expectations for seamless digital services, all while continuing to regulate the market effectively and achieve our objectives. Not an easy task. Our innovation agenda. The Dfsa is firmly committed to maintaining and delivering a robust, clear and proportionate regulatory framework. This regime sets minimum standards for firms, compliance with which will promote confidence in the market and help us achieve our other regulatory objectives. When we look at new policy initiatives, we take a thoughtful and measured approach. There can be unintended consequences that flow from regulatory responses to traditional financial services, let alone the unintended consequences to hasty regulatory responses to nascent financial technologies. Being the first mover is not always an advantage. I want to mention a rather challenging question. Do we have an opinion on the use of technology, and do we regulate the technology that's used? Justin touched on this earlier today, but at the Dfsa we talk about being technology neutral, meaning we place requirements on the firms using technology to understand the risks associated with it and to mitigate those risks, including explaining them to their customers when appropriate. But this does not mean that we don't look closely at the technology used and try and understand how it works, especially as technology is becoming so embedded in the delivery of financial services, and it's such a fundamental driver of the products and services being offered. I will mention again the guidelines for financial institutions on the use of enabling technologies that were recently issued jointly by the UAE's regulators. These guidelines talk about how we want financial institutions to act. For example, in relation to the use of big data and artificial intelligence, financial institutions need to promote fair treatment and ethical outcomes that are aligned with their ethical standards and values. In relation to the use of biometrics, financial institutions need to have in place the means to ensure the confidentiality, authenticity, and integrity of the data provided throughout all phases of an authentication process. To return to our innovation agenda, last year we introduced two major policy initiatives. Consumers want speed and convenience when purchasing goods and services and demand real-time access to payment platforms. They don't want things to be complicated. They want a seamless payment experience. This demand, coupled with market interest, led us to introduce a comprehensive money services regime in early 2020, allowing for a wide range of payment activities, including remittances, stored value, payment initiation, and account information services. We continue to see significant interest in this regime, and we're working with a number of firms who have applied or want to apply for a Dfsa license. Venture capital is an important source of patient capital for financing startups, so that, for example, new technologies can be transformed into commercially viable and sustainable businesses. In late 2020, in support of this funding need, we developed a regulatory regime to encourage and facilitate venture capital funding, expecting that this would support technology-driven firms in the Dfsa. You can expect to see more on developing this area later in 2021. Crypto assets, Liz Wallace has already addressed in today's session. We get asked by many of the firms what we think of digital onboarding, what we would allow and wouldn't allow, and so on. Basically, your firm is responsible for onboarding customers properly and for meeting your obligations. There are many different ways you can do that using different technologies. We're looking to see where we can usefully produce some guidance to help firms. What are digital banks, and how do they differ from what we know as a traditional bank? It's fair to say that most banks now are digital banks, but a pure digital bank is one that has no physical presence and, for its customers, the only means of interaction with the bank are virtual and remote. This can offer benefits in terms of speed and efficiency, as well as financial inclusion through wider reach and lower costs without legacy systems relative to traditional banks. We are guided here by the principle, same risk, same rules. So our regulatory approach to digital banks is largely to apply our existing banking regime. We will complement this with guidance on how some of those rules apply in the specific context of purely digital platforms. Turning to open banking, a system by which banks can allow the use of APIs as a gateway for third parties to access customer information. A main point of open banking is to improve customer experience and the value they get from specific services by letting them share their data with third-party providers, most importantly, in a secure manner. Examples of this are the payment initiation and account information services that I mentioned earlier. Like many other regulators in their jurisdictions, we're thinking about a potential open banking regime for banks based in the Dfsa. Typically, much of the debate on open banking has been on retail solutions, but open banking may have an even bigger impact on corporate and SME customers, where examples include treasury and cash management, instant payment and instant liquidity, and accounting and bookkeeping services. We are looking at both retail and corporate SME solutions for open banking. Artificial intelligence, money laundering, and technologies we are seeing used more and more in, artificial intelligence and machine learning, not money laundering, technologies that we are seeing used more and more in the financial sector, which helping firms to manage and understand ever-growing data sets and to identify previously undiscovered patterns, which is crucial for flagging potentially suspicious behavior. If used properly, these tools can distinguish between legitimate and fraudulent behaviors while adapting over time to new, previously unseen fraud tactics. The growing use of artificial intelligence and machine learning presents opportunities, but there are also challenges, for example, in respect of risk management, bias, ethics, and governance. Dfsa is considering guidance to set out our expectations in respect of firms using these technologies, which would expand on what is already in the joint guidance that I mentioned earlier. So, just looking at our innovation agenda, that's a range of issues I've mentioned: payment services, venture capital, crypto assets, digital onboarding, digital banks, open banking and APIs, and artificial intelligence and machine learning. Indicative, as I'm sure we'd all agree, that there is quite a lot going on at the moment. Lastly, we continue to engage with regulators and other bodies in the UAE with the common aim of developing an ecosystem where innovative firms can thrive. One project I want to mention is with the Centre for the Fourth Industrial Revolution, or C4IR, and Dfsa. There, we're creating a sandbox environment for firms to develop and test use cases for tokenization. This will advance our collective understanding of the collective potential benefits of this technology. We also continue to engage with international counterparts through regulatory groups such as the Global Financial Innovation Network, where we are enabling a number of firms to test their products and services on a cross-border basis. In IOSCO, we are part of the FinTech network and the Decentralized Finance, or DeFi, workstream to help us understand developments in this market. We also engage with industry bodies such as Global Digital Finance. In conclusion, we support the development of an innovative ecosystem in the Dfsa, in Dubai and in the UAE, regulating where appropriate and refraining from regulating where it is not needed. Being part of this ecosystem is exciting and a challenge for us. It helps us to address some of the challenges we face ourselves as an organisation. But importantly, we're able to be part of building something that is new, something that is different, and something that is future focused. Thank you.
Thank you, Peter, for the update. If you can now stay for the Q&A session. So we've got a few minutes to take on questions. Let's see if we receive any. All right, so does the Dfsa talk to other UAE regulators about any of the issues you have mentioned today?
That's a relatively easy one to answer with yes. I mentioned earlier the guidelines we've issued for the use of enabling technologies, and that's a joint venture between the Central Bank of the UAE, the Emirates Securities and Commodities Authority, ourselves, and the Financial Services Regulatory Authority down in the ADGM. So that's an example not only of us talking to each other, but of us actually producing something on the back of that discussion. That's the first product that we've jointly produced, but I don't expect it to be the last.
Great. How long do you think the authorization process will be for a crypto exchange, for example?
Well, they would have to apply first. I think it's an interesting question because it will depend, as it so often does in the innovation space, whether the people who are applying already have operations in other countries and have experience of working in a regulated environment, or whether they are a complete startup entity and have no previous experience of working in a regulated environment. As those who are taking part in today's session would expect, if it falls into the first category, then we would expect that to be a much shorter process. If it falls into the second category, with an applicant who's got no previous experience of working in a regulated environment, then we would expect that to take a much longer period of time. But in relation to something as substantial as an exchange, I think it's fair to say that we're talking a minimum of several months, absolute minimum of several months for any licensing process to take place.
Okay, thank you, Peter. We have one final question. How can we find out more about our crypto asset plans as they develop?
I mean, our crypto assets plans were covered in an earlier session today, but I think just to flag the next things that will happen, we expect to finalize our rules on security tokens, one part of the crypto asset world, later this month, and you should look to see something being published in July on that, I hope. And then we will try and keep the market informed about our next public consultation exercise on other types of tokens, including cryptocurrencies and the like, but that's likely to be later in the year and certainly after the summer. I would say register on our website and then you'll get the updates in terms of when we publish things. But our plan is to have finished the security token rules and consulted on the rest of the crypto asset rules, certainly well before the end of this year. Thanks, Howla.
Great, thank you, Peter. So we'd like to thank everyone who spoke today. As we mentioned, this is the third edition of the event, and we'll use this opportunity to continue exploring how the financial sector can leverage technology to drive innovation, deliver solutions, and help build a more robust regulatory environment. Thank you everyone for your time and for joining us today. Have a good evening.